On this episode of Flux News Show, we're talking about the recent relief rallies off the back of OPEC meeting and the tariff de-escalation with China and US. And we're talking about how the market is looking to normalize and the opportunities that are coming with that, but also potentially in general, some danger signs flashing for the oil market. So plenty to get through, trade ideas and the like. I hope you enjoy. Okay, so just to warm up this time, we've got, for you two, I know the answer.
Okay.
We've got, the themes that we talk about. You've got to guess from the graphics on here what this is referencing. It's a bit of have I gotten used to you vibes going on. Okay, so there's a green blob on the right, which is meant to be China, by the way.
Okay.
We've got the shaking hands.
Yeah, so some sort of deal.
Some sort of deal.
What could it be?
Yeah. Come on, this is easy, right?
So do we think it's the US, China have agreed on tariff de-escalation?
Yeah.
Just an easy one to start.
Yeah, that's nice and simple.
We're bringing this in more and more next time, but just a little
It could
taste.
also be it could also be the cover of the next edition of The Art of the Deal by Donald Trump.
Yeah.
Nice. All right, cool. Okay, let's now get into the rest of the show. So Mita, what's the dealie?
So in terms of an objective temperature, I would say going towards hot.
Objective
the temperature is like
What's the objective temperature?
in terms of like a word, for example, I would say definitely towards hot. Like trading volumes, for example, are picking up.
Yeah.
This is just the 4-week average trading volumes in the M2 Brent futures. So you can see there was a small dip right after the OPEC meeting, but it's picking up again. The market is finding its feet, and that people want to put on more risk, which is interesting. In terms of historical volatility, just 30-day price volatility, that's the blue line over there. That's also picking up just because of how the changes in price, the rapid oscillations in price, essentially.
Yeah, so we, getting more into volatility, that's something we're going to add now to this show. Obviously, very important indicator of the market state. So you just mentioned it, obviously the volatility has picked up. Is there anything more about what's going on in the options market?
Yes, so it's interesting that historical volatility has picked up because of the swings in prices, but implied volatility, which is inferred from options, like the options trading, has been selling down since the OPEC weekend, essentially. So it was artificial, it was bid up, but that was essentially all panic induced ahead of the meeting and what would happen in it. So after the meeting, things have been selling off. The skew then in the week 2, the OPEC meeting was towards put options. And while we still see this bias towards puts, we have also been seeing a lot more call volumes picking up. For example, the SEP 95 call has been continuously being bid up around 107,000 lots since the OPEC meeting. And this is interesting because the SEP option expires at the end of July. So some might think this could be a short-term play on crude.
Yeah, I think, we got to talk about this as well, but the market has kind of flipped quite heavily bearish sentiment. All of a sudden, just the Saudi announcement and just the OSPs and things like that, suddenly it feels like we're in quite not just a bullish market, spot market margins, like we've said, actually quite a bullish market state. And I think from a sentiment perspective, and as you say, if people are buying a lot of call options, I guess that's a good indication of people still thinking there's decent geopolitical threat out there. Obviously, we've got the India-Pakistan thing as a new thing for oil markets to react to, and obviously, the normal kind of risks that we've had in the last few years. So, yeah, it kind of makes sense that it's picking up. But I guess it's surprising to see just how much. Basically, it looks like a lot of people are taking profit on the puts and the volatility, right? And I think if we go back a few months, coming into the year, or early year, there was the bearish sentiment building up, and I think people generally felt that it was a good year to be short. The balances, the supply and demand balances were all indicating that. So the analysts were suggesting that, the hedge funds are putting on short Brent spreads, and people started buying up puts. But it just wasn't really going there, right? And we're talking about how nothing was really changing from a production perspective. And then it was the demand shock that we got in the end, not the supply shock from the tariffs, and that created this vol spike and the move down. So if you were holding options, you're holding put options, full disclosure, like we were, it was a bit of a you just felt lucky because, you know, you're holding puts because you felt like the market decline, the volatility was relatively low at the time. It has this massive spike because of something you could never have predicted.
It wasn't why you did it in the first place.
It wasn't why you did it in the first place. So I think like, us and probably everyone else who was long the puts was like, well, that's what, you know, that's the time to take your money and take profit off the board, because you're never going to get such a huge implied volatility spike out of nowhere. So if you want to be directionally short, holding puts no longer makes sense, because if you're buying puts and it's, you know, the vol's gone up so much, then they're more expensive by definition of how options are priced. So to be buying them at that level is the risk reward just kind of gets destroyed. So you sell out of your option, and then if you want to still be short, you sell the outright price. I think a lot of people looks like they did that, if not just sold puts and just called it a day, because we were, you know, flirting with 58, 59, and so that was kind of what was on the cards.
And the headlines were very unpredictable. So it was like you say, there was an event where you felt like maybe I got a bit lucky.
I think I think a good representation of that is the 25 delta risk reversal as well. So that looks at the 25 delta risk reversal. So that looks at selling an out of the money put and buying an 25 delta risk reversal. So that's the 25 delta put versus 25 delta call versus 25 delta put.
Do you want to explain what that is?
Yes, sure. So that's
the 25 delta risk.
That entails selling an out of the money put and buying an out of the money call for the same expiry, essentially. So if you look at that over here,
but what makes it 25?
That's just so that'd be like it's 25% of it being in the money. So it's significantly out of the money right now. Is what it does. So if you just look at this chart, so the yellow line over there is the 25 delta put, and the white line over there is 25 delta call. So you could see the spike just around the OPEC weekend, which is exactly what you were just saying, that you had that incredibly bearish time in oil. And while put volumes are still higher than call, the skew is still towards puts. That difference between them, that is the 25 delta risk reversal, is significantly narrowing. I think right now that might be more that the market is stabilizing, but I definitely think it's a good change from the bearishness we were seeing just 2 weeks ago.
And as you say, like if we talk more just generically about the market now, like it's just so funny how quickly sentiment can flip. So 411,000 barrels per day is the headline increase. People were still selling after the OPEC meeting. We did have an initial gap down after the OPEC meeting, but that graph's a very good indication of it peaking and then suddenly almost reversing, and people thinking, well, actually, as the news comes out more materially, as the Saudi OSPs come out and prove that they're not actually trying to get into a price war, and then people are talking more and more like, oh, hang on a second, is there any actual production coming online? Because it's just pulling back cheaters. Suddenly the sentiment reverses and starts gaining traction the other way. And that did play out in the market. But it does also show you or tell you, I think, that the market was overly short and overly, you know, trying to see this downside, that when things materialized, I think we said this last week, the risk off move was bullish. The risk off move was to buy. And the same with options, right? So now it does make sense that the call put skew, basically, right? That's what you're saying. The puts were way cheaper than the calls were bid. And that's kind of narrowed a bit towards the upside. So people are now kind of in a bull state. So if we marry the volatility with the volume increasing, that's more conviction. I think that indicates, I'm sure the open interest would show kind of people starting to put risk on again. So all in all, I kind of see a point, as we said, temperature, as we're calling it. Yeah, I guess it is warm to hot, right? That's pretty fair summary. So now let's talk about the herd mentality. So herd mentality being, what is the headline or theme that the market is most reacting to? And I think then more, you know, this week compared with last week's, it's quite an interesting one. You know, usually it's just like a headline that everyone knows, but I don't think this has been the case. And we said last week that we felt that going forward, and I think for the week previous to that, it was more like industry things were moving the market. I think you can say that. I mean, it was Saudi OSPs, there's so much concentration on that. But there's loads of like things in the minutiae at work, and it feels like people are genuinely, from a flat price perspective, from a real outright price perspective, as well as the, you know, product cracks and all that, people are looking at the industry stuff, I would say. I guess when you have some moves around headlines, and then when markets, like you've had gasoline's had a really good run up, like refinery margins have been like hot for a while. Eventually it has to come to the point where everyone's like, okay, like
at some point you can't just have these like hysteria rallies forever. Like at some point the fundamentals have to come into it.
Yeah.
And when you marry that with headline fatigue, like we said last week on EBOB cracks, it's like, you know, and fuel cracks, it all has to come into the picture at some point, because margins, you know, people want to hedge margins, you know, people want to take profit on positions. There's been moves that like people have want to monetize it. And then when the headlines kind of die down, it's like, well, yeah, you kind of have to focus on this, don't you? And we said it, yeah, for the last 2 weeks that the physical guys and the like industry guys, they must be focusing on like, you know, what's actually going on in like my market right now.
Yeah, like, I think that the theme or the word that gets used in the industry quite a lot is like the normalisation trade.
Yeah.
Which has been a big thing for the industry for the last few years, because we've had wars and we've had such huge volatility spikes, and then it kind of like destroys everything around it in a weird way, or blasts things around it.
Yeah.
And then when it calms down, you left with this market that's got all these things out of whack that you can then go, what is the industry, or what is the actual underlying market doing?
Yeah.
Is this reflective of what's really going on in the underlying market?
Yeah.
And if it's not, that's a great opportunity to mean revert.
Yeah.
And that normalization trading has, I think, proven quite profitable for a lot of traders. Like, for example, 2022, okay, it wasn't oil, it was gas, but I think a lot of the money wasn't made on the way up. It was made on the way down, because you were pricing in power prices and gas prices that were like in Europe, like the entire German GDP would have been spent on power if the prices maintained at that level. So these normalization trades are where people really make their money in the industry. So it's a great point, and I think that is what's playing out right now. It's not quite as out of whack as it has been maybe in previous years, but certainly enough to kind of put some conviction. And I think the one thing I've been interested, I think we'll talk about it later, is we've put the refinery margins in focus, but we're coming into summer. It was a very hard one to judge, particularly with gasoline. If you got some high conviction, gasoline has been one of the ones to come off, which I think was pretty interesting. So it just kind of verifies that one of the hottest contracts that wasn't particularly too risk on. It wasn't like there was massive open interest. Even that contract is weakening before we've kind of get into peak summer. I think that kind of does put, like, basically as an anecdote, does give you the picture of markets normalizing, basically.
Yeah, because that's like the one
that you would expect.
That's the one you would expect if there's like a, you know, sort of
real bull rally,
like gasoline will like for sure be like involved in that coming into the summer. So yeah, I mean, that's kind of from memory, like that contract in last week's moved pretty sideways, right? I mean, volatility's died down a bit, and there's been a bit of a,
that's the rolling B-roll crack there on the, so I guess it's come off decent $1.50-ish.
Yeah, the last, like this week, it's kind of come off a bit. Yeah, so, well, I mean, fuel oil just keeps going up, but
apart from that.
Yeah, so it does feel like that kind of normalization in EBOB, you know, like you say, coming to summer, maybe people.
Yeah, slightly. It's still at play, though. I think the increasing volumes in Brent futures, and I would say for sure increasing volumes in swaps, is people coming into rush to do those trades. So it is a good time to be trading, because the volatility's died down, that kind of sting is taken out of it, that danger a little bit's taken out of it, and now you can look for it. So yeah, I would say it's a good time to trade.
Yeah.
So, but sticking on to the theme of this point, you know, the herd, Mita, like give us a few things. So what do you think the market is reacting to, or could be reacting to going forward?
Sure. I completely agree that a lot of these factors now are physical oil related more than, say, what we've been seeing with the tariffs and macro things. For example, this week, we've seen the Saudi Arabia crude allocations to Asia. So total allocations summed up to around 47.5 million barrels, which was similar to how it was last month. And this steadiness month on month, I think, displayed to the market that Saudi Arabia will not be going for a market share war, especially after the OPEC increase in output and everything. And the market is probably just looking for this after the OSP announcement and after the OPEC output increase announcement, just everyone is really worried about Saudi Arabia going for.
Well, people are looking for certainty.
Exactly.
What are they up to? How can they announce an increase during the peak tariff? Like, what is going on? So yeah, it makes sense that people will be looking at them quite intently. So the allocations are basically up.
Yes, but they've been more steady month on month. So they're still high, but pretty similar to how they were last month. Okay. And I think that, as I said, the steadiness is something that it hadn't been really high, for example. A lot of people might be worried about a possible market share war.
Just for the audience, we've got, so two key things, right? So the Saudis, or the OPEC, released their quotas, what we're going to produce, up or down, and then every country, but the Saudis are going to then announce their official selling prices, which is like a differential to the benchmark. Basically, it's undercut or it's lower, it's going for market share. If it's higher, they're clearly not so worried about demand.
And it went higher
what
this
about
time.
allocations? How do
And
you?
then, yes, sorry. So about the allocations, again, it's more about the volume of their crude that goes to different to different refiners in Asia. For example, Rongsheng got the biggest share at 16 million barrels this month. Sinochem, Hengli, Shandong all got allocations increased. Unipec got a cut to 10 million barrels.
Okay.
So again, this just shows the allocation that these refiners are going to get from Saudi Arabia. People are interested to see whether, again, a massive increase could be that they're trying to maybe get rid of their barrels or increase market share.
It's like basically another indication of market share play, that kind of
yes,
stuff.
exactly. So had this been incredibly high, for example, that would have shown that the Saudis want to increase their market share in Asia, and that would have weighed down on the price of Brent.
Yeah.
So
well, it's the Brent versus Dubai differential, that proxy for OPEC trading and the kind of basically East versus West supply balances. Ultimately, that's been a pretty crazy ride, because you had a very short market like we've been banging on about, and the gap up on the way up to the meeting made a lot of sense. People trying to get out of that contract short, and it's a very low level. So as things came more into balance, Dubai crude's basically having more supply. It made sense that would rally. But then since, it's had a very volatile ride. It's also got cremated back in some of the contracts, probably less so in the front one. But the point is that is a good indication of like how people are trying to judge what is actually going on. What is the likelihood going forward that we're going to get more supply? And I don't think people are finding it that clear at all. If anything, the volumes are probably dying down in Brent Dubai, and people are probably a little bit worried or low conviction at least.
Definitely, yeah, I agree.
So it makes sense that they would look at off the back of that. And I would also say, if you're looking to trade on OPEC news and this kind of stuff we're talking about for the outright prices, you should still look at Brent Dubai as the proxy. So in a weird way, it's like when Brent spreads, the time spreads are going lower, that's indication of, I would say, the market's kind of macro interpretation of physical demand or supply and demand, basically. So that's weakening. Then you should be buying the Brent Dubai, because if it's weakening, that means you think there's more supply coming back from OPEC, because they're the swing producer at the moment. And if OPEC are producing more, then that's going to weaken the Dubai benchmark relative to Brent, and the market's short, so Brent Dubai should rally. So you've got that kind of inverse correlation right now. Brent spreads rally, Brent Dubai comes off, and vice versa. So I think that kind of, I wouldn't say as an outright trade that's necessarily a great trade, but it's a good pattern to watch, and it will dislocate at some point. But I think that makes sense. Like, what other reason do you have to be bearish other than that, or bullish? For example, if you're bullish, it means you don't think the Saudis are going nuts. You think they're going to hold back, so therefore the Brent Dubai should probably hold, if not come.
I was going to say that like the Saudi production is kind of seems to be what sort of like hinging a lot of sentiment, right?
Yeah.
Like that was what people were sort of pre-positioning maybe going into the meeting.
Yeah,
it was always, well, not always, but it was going to be about how much they turned on the taps, and I guess that's kind of just what people are looking out for. So,
and we've talked about headline fatigue, but of course the tariffs had some impact, right? We had the China de-escalation with the US that did cause a price rally in the outright prices, like $1.50 or something in Brent. So that's, to be fair, people are still looking at that, but that would have been like a $7 rally a few weeks back.
Yeah.
So that shows you that market's less interested in that.
And always a bit like, what's the word, like skeptical of just, okay, you said that today, but what are you going to say tomorrow?
Definitely.
You don't want to put real risk and real money onto something that. But having said that, there were other contracts that reacted, like the propane contract I think you'll talk about later. That had a huge impact, but that was a very nuanced, very specific thing.
Yeah.
But just sticking on this, because I think it's an important section. Anything else? Like India, Pakistan, I guess, didn't have much impact either. So what should people be looking for then? Headline or themes or heard? Are we saying it's still the industry?
I think it's still the industry, definitely, because as Harry just said, with Trump, there's one of those things where you get your information from Truth Social and then you get it from the news, and then by the time you get it from the news, everything's reversed again. So definitely, I think still the industry. People just want to see some stability, I think, at these levels.
But from a normalization perspective, I guess, there's probably a bit more in there that's like, trying to read between the lines a bit. It is quite telling of like maybe they're like fatigue in this sort of trade war that they embarked on briefly. That if they are kind of agreeing to these concessions on tariffs, eventually are people just going to think, well, are you just eventually just going to back down from all of it? Like, they haven't really shown much like grit with it. if they're already kind of walking back on everything.
Yeah, the only thing though is like it has been a couple of months, right?
Yeah.
I mean, so I think the economic data being lagged next quarter, when we get the previous quarter's economic stats, I think they might reveal like some pretty heavy stuff on like port traffic or basic economic demand, manufacturing, things like that. That will then, people will then trade off in the macro market, equities, whatever, and then there'll be talk of recessions. And so I'd be a bit wary as to like, yeah, I know what you're saying, as in like people probably could probably have confidence now to some degree that it's going to normalize, but that's not to say that there won't be talk of recessions and demand.
There's still a bit of turbulence to go through.
Still a bit of turbulence to go through.
We do have US CPI data coming out today, which could have like a short-term impact on price if it impacts global markets.
Yeah, but I don't think the market is looking at it. So let's see and then go forward. But I think our summary is basically maintaining like the underlying physical market industry plays will drive the market going forward. Okay.
Yes.
So to get a little bit more minutiae in what we're talking about, we're going to pass to the officials. So hello guys.
Hello. So we're going to talk a little bit about kind of Saudi allocations, what we're seeing in the spot market as well, and a little bit on the North Sea, to kind of get that kind of east-west comparison as well. As you've been discussing, we got that kind of moderate hike to OSP, so kind of 5 cents lower than implied, but some 20 cents away what would be indicative of a price war. And then we got the Saudi allocations again, which were 47.5 million barrels, so 500,000 barrels less than last month, but still pretty elevated on a kind of a historical basis. They averaged 41.5 million barrels for July 24 through to April 25. But nevertheless, as Mita pointed out, that steady month-on-month progression is clearly not indicative of a price war. And also, you do have to remember as well that these are allocations going to China, and there's always that Chinese push at 70. They're big on energy independence. That's a key sort of policy for them. So they will just buy and stockpile when flat price falls, which is flat price basis.
Which is exactly what they're apparently doing.
Exactly.
They are building their inventories right now through this low flat price.
Exactly. So it's opportunistic in many ways, and unsurprisingly, the market has read this as bullish. With Saudis unlikely to turn on the taps. We've seen Goldman come out saying that they're expecting another 411 KBD unwind next month, which is certainly possible. But again, that would most likely not materialize in new barrels coming online. That will be kind of a paper unwind as we saw this month. And then so that kind of brings us onto the spot market, which has really been strengthening so far this month. So like back in the last month, we saw physical premiums around 77 cents. And that's really strengthened up to 167 on Friday. And PetroChina has been a key buyer here with Vitol selling into them. They both switched sides this month, which has been interesting. We've seen really quite bullish reaction in the buy physical. But in the North Sea, we've seen a little bit of a different story. The physical differentials have been coming off pretty hard this last week. Do you want to talk?
Yeah, it's kind of the opposite story. So we've seen a lot of offering of Midland, particularly by the likes of Gunvor or Aramco, and the physical diff had been kind of quite stubborn for quite a long time through like March and April, near $1. But in the past, just over the past week or so, it's dropped very, very rapidly. And now it's approaching, on Thursday, it was approaching near minus 50 cents. Now it's come up slightly, but it's still very, very weak down the dumps. And this is really showing what you were talking about earlier, really, with the east-west divide between Dubai and Brent, is that in the physical market as well as the derivative Brent-Dubai market, Brent is underperforming Dubai. Dubai is much stronger, largely thanks to this, I think, this kind of the soothed doubts about about the Saudis opening the taps and flooding the market.
There's also an interesting refinery closure, wasn't there?
Yeah. So Grangemouth in Scotland was one of the refineries processing a lot of 40s crude, and that's now closed down. So we're seeing more 40s being offered in the window in the North Sea, and it should increase loadings by around six loadings per month.
Yeah.
So
Starting to see 40s kind of
setting
the data benchmark a bit more,
becoming a lot more competitive.
becoming the competitive grade in the basket, which has been interesting to see.
Yeah, and then one of the other physical things to keep an eye on is the Ecofix field, which has maintenance coming up in June.
Yeah.
So that will cut its loadings down quite significantly.
Yeah, and if you want to CFD structure, moving into calendar June, it's
it gets quite a bit stronger when you look into June. So that's potentially a reaction to that. So there is potential for it to the situation in data bread to improve, the physical market in North Sea to strengthen, but for now it does look pretty fragile.
definitely.
That's a great summary, guys. Thanks. As you picking up on a few of those things that you were saying, it is interesting, slightly contradictory to what I was saying, I guess, from the East versus West kind of relationship with Brent spreads, because as you say, it's actually the spot Europe market which is underperforming the Dubai. But I guess because it's spot, that's the thing about derivatives, right? You're trading things in the future. The spot is much closer to the prompt. So to some extent, it can divorce from what's going on longer term. So as you said, a bit of a relief rally in Dubai maybe, but the European weakness on crude, that is interesting. And I think, again, is it supply-led or demand-led? Well, the refinery margins are strong, but there is maintenance, I guess, people come out of now, but as in that may have had some impact potentially. You would expect a blip. But as you say, the marginal barrel being on offer, and that is how pricing works, how settlement works with Platts, right? Ultimately, it only needs one barrel that people can't buy because they've all satisfied the demand in local refiners, or they can't send the cargoes anywhere. So one barrel can then just go into this tendering window, go down, and then weaken the physical differential, which is the benchmark for 70% of the world's oil. It's amazing to think one cargo on offer can create such ramifications for the world's price of crude. But anyway, it's a good point that you bring up. I would say that looking at the market in dated Brent, which is ultimately the spot market reflection, or what the North Sea players think of the spot market in Europe, there is quite a lot of hope in the June versus July time spread, or the June to July kind of summer barrels, basically summer rally. There is a lot of hope still in that market that's going to really perform, and the forward prices are looking like the physical differentials should massively rebound, which again should make sense given the state of the refining margins. So that's nonetheless very interesting, because the spot market is when things actually come out, when the chickens come home to roost, right? You can make all your claims about the forward market, but the spot market is when you really gauge what's going on. So that's really something to look out for. So again, these guys are publishing twice a day, posting on LinkedIn and Flux.live. You can read their summary there. So thanks, guys.
Thanks a lot.
So one thing I would add to what they were saying is this refinery margin thing we've been belting on about so much. Mm-hmm. When looking at the positioning, and generally speaking, when refiners actually came in to do a bunch of hedging, I think a lot was done at the beginning of the year for the rest of 2025, and it was a lot lower. So refiners, I think we did a volume weighted kind of entry price study on that, and they're quite a bit out the money, which is fine for a hedge, right? That's the whole point. You're just locking in forward prices. If you lose on the paper, you'll make on the physical. But that does go away to explain that maybe refiners aren't bursting to buy crude in the spot market if they've already locked in lower margins, and it's not just a free-for-all. So if anything, they have to buy back their hedges, see another rally for it to be like, and it's probably unlikely to happen. So they're just kind of stuck with these hedges. But there's definitely not a refinery market that's ever 100% hedged. Yeah. So I still think there's a very decent amount of profitability from refiners that can profit from the spot market. But I think that's worth indicating, because you would expect the margins where they are for the spot market to be flying, really, especially if the supply isn't flooding back from OPEC. So anyway, it's just another thing to note. Yeah. So now we will do the hedge fund watch.
Yeah, so just to start with, just looking at just positioning data from the CFTC.
Yeah.
Managed by money long positions declined to 207 million barrels. This is in Brent in the week ending 6th May. This was its lowest level since the beginning of November 2024, so in around 6 months.
Hang on, sorry. This is what contract?
Brent.
Brent long positions decline.
Yeah.
Okay, yeah.
Just Brent long positions. Our own timelier CTA model shows also remains net short, and it shows declining positions in the week ending 6th May. But over the past week, we have seen length come back into the market, and we see a lot more potential for upside from here, because considering how short the market is. So that's interesting, just in terms of hedges and with what funds are doing. But just in terms of more like news, like what's happening in like with hedge funds outside, recent data from hedge fund research shows that macro hedge fund strategies lost 2.7% in April 2025. This matches their loss around from March 2023, when the US was having a regional banking crisis. And this essentially happened due to
this is all hedge funds everywhere.
This is it's just an overall macro hedge fund strategy.
Oh, right, okay, yeah.
So this happened because these losses were essentially driven by the sharp breakdown in correlations across different asset classes due to Trump's tweets and the tariffs and everything.
Or just the risk-off move and equity.
Exactly,
I think there's a lot of that's going to be equity-driven. But in oil, I mean, and commodities, it's been probably even worse, I would say. The average hedge fund hasn't done very well with the tariff news and all that. But I think we've probably covered that enough. So how do we think? So we think the hedge funds are generally still on the short side if they're positioned.
Yeah, so our CTA model, for example, I'll put this into post-production, but this chart over here, so we still see that's the zero line. So we're still significantly short. We're still pretty close to max short that we've ever been. But considering that risk is coming back up, considering the volume,
but that's the momentum, that's the algorithmic trading. You've got the discretionary shorts are also, discretionary longs are decreasing, right?
Yes.
So there's a fair amount of de-risking there. But I would say that also coincides with a recent rally, right? And $5-6 per barrel is not like huge historically, but it's enough. Short-term rally, relief rally, for example, like people buying off the tariff news and people buying off like normalisation after OPEC and it not being as bad as it was. You then expect them to take profit, I think. So that could be all it is. I would say on balance, if you take the CTAs out of it, it's a relatively like balanced market from a risk perspective from the hedge funds. I don't think anyone's piled in deep from a hedge fund perspective. Anything, allocations of money and having traders, there's plenty of traders who are well known in hedge funds that are retiring this year, obviously a bumper like 4 or 5 years. So if anything, I think they have money to deploy and they're not doing it as much as they could right now because where's the conviction, that kind of stuff. So
have we heard much in the way of like products or like dated Brent funds kind of deploying risk into,
as I say, more people leaving. So if anything, it's de-risking and the volume coming out of the market.
That RBOB to heat
a lot of profit taking there.
Seemed like there was some profit taking RBOB to heat.
So I'd say they're in the sidelines, and if anything, I guess you were kind of making that point as well, Mita, with CTAs. Like they're dormant, but they could come back on the market quite aggressively one way or the other when there's a new event. It's hard when you say we're expecting more upside. I can see the argument, but $65, $66 with the current environment, it's still really hard to be very bullish, I think. I think we said a few weeks back when it got up here to 66, 67, we're like, well, the CTAs could really flip here and go long and create another $5, $6. There's always that risk, but the longer it goes on with volatility dying down, I don't think that's the high conviction trade for anyone. Does anyone want to be really long outright prices? They probably want to be long calls, and hence the buying. You want that out the money, buying those 95 calls that people have been doing to have that protection of something. But I think if anything, you're going to be short the outright off the back of that. And that's more of a volatility play, given it's come off again. So I don't know.
I was going to say, do you think those 95 calls, is that more of a just like a kind of volatility? Maybe that's just like cheap volatility.
And also
buying
just
cheap
like,
they don't necessarily, maybe one for the viewers, like they don't necessarily think that Brent is going to just spike to $95. It's just that might have been quite a cheap way to buy volatility.
Given the current scenario, maybe off the back of India-Pakistan, like escalations again. I mean, it's not a terrible idea. I mean, it's certainly if you're running a huge book as well, you need some protection in case these things happen. And if something's relatively cheap or cheap relative to recent times, then it kind of makes perfect sense why you do that. So I wouldn't personally read too much into that. And I think the hedge funds in general, they're not going to be giving us much in the next few weeks, maybe months, in the commodities market, or just certainly the oil market. And they're going to be waiting for the next, the big move. And again, if I rewind back to 23, like, you know, when there's nothing to be done on the prices necessarily, or the outright price, they're going to start looking for those other trades, like the RBOB versus heating oil, like the more minutiae normalisation trades. So I think if anything, we should start to see some volume coming in to the gas oil cracks, things like that. We can talk about that a bit later. But all in all, I guess we're saying a bit nothing from hedge funds, just de-risk mode.
Yeah.
That's doesn't seem like it,
Okay. All right. Now let's move to where money has been made. Let's do the gold rush.
So this week's gold rush, for that we'll be looking at the very low sulfur fuel oil spread. So that's the June-July Singapore 0.5% spread. We've seen a lot of buying across the fuel.
So let's just describe what this is. So this is basically the new shipping fuel from 2020, right? They had the requirement to have
IMO compliant.
So lower sulfur, but still like heavy stuff usually, right? Like very mucky stuff that just has low sulfur, but actually trades at bit of a premium to crude now. So go on. So that's been performing quite well in Singapore.
Exactly. So this is Singapore 0.5% spread. So this is fuel oil that has 0.5% sulfur in it. And that's IMO compliant for shipping fuel across the world. So this is the June-July spread, of the prompt spread. So just looking at it on my screen over here, it has seen a pretty significant rally recently. And a lot of this has come from trade houses and physical players buying at low levels over the past week, 2 weeks. So this rally essentially started with back-end cracks, interestingly. So we saw physical players and trade houses buying Cal 26 and Cal 27 cracks. But then this buying fueled sentiment in the prompt as well. And we started seeing players buying cracks and spreads across the curve.
Yeah, that's a seriously big rally, actually.
Yeah.
And I don't know a huge amount about the market, but I would say that, I guess with with the high sulfur fuel market being so strong, and the talk was that, you know, basically more and more ships don't need or have made themselves able to buy the much cheaper high sulfur fuel versus low sulfur and then scrub it on their ships. They bought the equipment to do that, so they can But having said all that, it's gotten so strong, the fuel market, that maybe it's just one of those things where the differential between the low sulfur and the high sulfur is just narrowed too much, that low sulfur has to rally as well because the demand in general is just so good.
And it's quite telling. I think you said about last week about, you know, looking at how the market's reacting to flows and news, but it's quite telling. Like Mita, you said that there was, you know, this might have been initiated by deferred crack buying. Well, from a flow perspective, when you have deferred crack buying, mechanically, like one of two things can happen. Either your forward cracks can rally to kind of keep everything in line, or your time spreads can weaken to keep the deferred cracks. You know, if there's buying in the deferred cracks, if you're in a weaker market, the spreads will tend to sell off. If you're in a strong market, the front cracks will tend to rally. So the fact that you've got the cracks in the front end and the front time spreads rallying, like along with deferred crack buying as well,
It's just a general rally.
that's like a, you know, that's indicative that you're in quite a bullish market. That, you know, the potential for like a bearish flow in the time spreads has not materialized, has actually gone up.
Yeah,
it's quite indicative that you're in like a fairly bullish market.
Yeah, come out of nowhere, really. I mean, it's not the biggest market as it is, but it's for it to rally so much after like diesel not being that strong, or I guess fuel being strong. It's kind of come out of nowhere, but maybe it does indicate the shipping market in particular, and that's anything I can really think of. Or if not, just speculation on low levels and it all coming in at once and a bit of a herd move.
Yeah, I mean, like this Singapore fuel market is traditionally very herd driven.
Okay.
We know that the spec guys favor being long. The trade houses tend to be spread buyers. So yeah, they're always looking to make money on a spread rally.
I guess, as we said, if there's nothing to do elsewhere, they look at these minutiae and get together, get a bit of a consensus forming. Yeah, actually, hang on, these contracts are a bit cheap.
And it probably looks a lot tastier than high sulfur fuel. You know, if you're thinking like, where can we pile in? Do you want to pile into 380 spreads when they're $15?
And everyone's made their money on
plus $3 cracks. Like it's probably a lot nicer to be like, if that 0.5 versus high sulfur spread is at like an all-time low. Yeah, you'd probably rather pile into the cheapest one.
Yeah, fair enough.
So just looking at this, just looking at my screen again, you can, as Harry mentioned, we do have trade houses buying this spread again. And this is just over the past month against Onyx. We see trade houses continuously adding to their long positions against us.
Yeah.
And so just extrapolating this for the entire market, you see that a lot more pretty significant trade house buying. And this is just in the prompt contract. So
yeah, so that backs up what we're saying. And I guess the volatility obviously increased. There's been a trend breakout. All the indications of, just like a decent, basically risk on move. I guess the next thing would be watching the open interest and how much. Can you scroll up to the crack, let's say, the low sulfur crack in June?
Definitely, yeah. In positioning?
Yeah.
Yep. So that's over the past month.
Yeah, so you can see, right, it's definitely outperformed the average, 5-year average by quite some way, which again makes sense. And we're not too far away from the kind of ceiling or like the 5-year max. So yeah, that all basically makes sense. Maybe scroll down on the crack, just see, are we on a long short basis?
Just against us, it's short, but
yeah, well, that's also interesting, right? So then if that's the prompt crack, and people are buying the back end crack and the time spreads, then maybe the front rally has all been about basically short covering.
Yeah.
And basically maybe the whole back end thing catching them unawares, and it was a bit of a fickle short positioned market. So that also makes sense. But it's one of those things that I would say, unless there's a really strong story behind this for people maybe not tourists, but people like looking in, like us right now, we're not experts on the low sulfur fuel market. I wouldn't be wanting to pile in on this. Like if it was a technical trade, fine, you can look at it, the breakout, that kind of thing, ride the trend a bit. But it's just such a big move that come out of nowhere with such short covering and things like that. Like, what are you buying into if you're going to go and join?
Yeah, I imagine a lot of people are probably just thinking, the summer rally, right?
Yeah, true.
Like, how can we position for the summer rally? Is there much correlation between EBOB and VLSFO? I mean,
it's like you say, they maybe just picked the one thing that was just lagging behind everything else. But I can't help but think it's dangerous for a crack to be moving so high or much higher in an already very strong refinery crack or refinery margin market. So anyway, in general, I'd stay out of this one. You have to kind of give it to the trade houses. They've probably just done, as you say, gold rush. They've probably just done very well collectively on that.
Just adding to what you said. So even if you look at this from a technical perspective, I completely agree with you. So just on my screen over here, you see so this particular candle over here where you see a top and then a resistance over there, after which you start seeing declines in price. So that's called a hanging man candle, which sort of symbolizes exactly what it looks like. Like prices try to reach a top and then immediately start seeing resistance. And that tends to be a bearish signal for sentiment. The second panel over there shows the MACD that looks at recent momentum, and you can see while that is still positive, the histogram is still above 0 and in the green, it is coming down, which isn't a great sign in a strong rally. And the RSI is also coming down from 70, which was the overbought territory. So you can see that we might have hit a ceiling in terms of price action.
Yeah, interesting. Okay, so maybe even potentially a short there. But as Harry said, like this is, particularly the Singapore fuel oil market and the low sulfur fuel market, they kind of do move in herds. They do know each other. Like if something's going on, there's probably something in the physical going on, and you want to be a bit careful. But
and even then, it's like there's always that market where the old adage of the market can stay illogical longer than you can stay solvent. If there's enough just pure momentum in that market, it can just keep going. The big physical guys were very happy to price out like very large volumes on spreads just to keep things where they want them. It's you might be right, but it might not happen, basically.
Yeah. I think the only thing I'd add as well is, with the state of the fuel oil market being what it is, Russia did indicate that they wanted to bring their supply back increasingly going forward, and kind of, again, their normalisation off the back of what they hope, I guess, will be a ceasefire and the rebuilding of their flows. With Singapore Singapore fuel oil being strong, it's a goodish proxy for, I would say, the crude that Russia produce and the vacuum gas oil that the Russia produce, and that is like very historically been in demand from the US, for example. Obviously hasn't gone there for a long time, but that was a very structural flow for a long time because it's great for the refiners out there, and it's generally a useful product for secondary feedstock. So that getting too ahead of itself, fuel oil market and the low sulfur fuel market, and heavy crudes being still in a bit of a rally here, it's toppy. Like it's like there's basically a lot of very linked supply to this due to come back online. For it to rally now, it's Honestly, I don't think it to me, just very anecdotally, it doesn't quite make sense. I mean, where is the shipping demand coming from in the whole tariff situation? Where is the huge tightness coming from that wasn't there last year? We were in a tighter market, a few months back, or a year, 6 months back. I don't know. That it kind of indicating something's going on that we're not aware of. Maybe it's localized strength, and it's one of those things where you got to remind yourself that you are trading basis, right? You are trading a contract that is a very specific region. So Singapore is Singapore. It's, you go and fly in, you see all the ships. It's the pump station of the world, if you like. So it makes sense that fuel oil was priced in that region for the East, but it is only one region. Like, there's so many regions with such big populations, China, India, Indonesia, all these places. Japan, South Korea, if you start looking at those premiums and get a gauge for the physical health there, that's probably your best bet right now, because it is getting so strong in those markets that you're thinking, is this real? And if it is real, and everything physical premiums are everywhere in the East so strong, and even Europe, then we need a story here. We need to understand what the hell's going on, because OPEC's meant to be coming back online and Russia may be back online. So where is this appetite and forward demand or forward supply crunches in these markets? It's quite interesting. It's probably something to focus on.
Yeah, and like you say, whatever it is, it's not obvious. You have paper positioning, but it's still not necessarily obvious. I mean, one question I have, which I actually would like to know the answer to, is there much of an interaction in the refinery between components for VLSFO and components for gasoline? If you have a stronger gasoline market, does that pull away from VLSFO blending? Because VLSFO is a blended product, right? So does stronger gasoline market pull from blending components for VLSFO much? I mean, I never really historically thought it would do that much, but
actually, that's the physical traders, right? And that's ultimately why, that's the divide between us, right? We don't trade the physical. We obviously hear a lot here and there, but that would be a great question to pose for someone else. I mean, again, that's why I bring up the vacuum gas oil, because it's never been a very traded derivative contract. Maybe it should be, because it's a big staple, like secondary feedstock thing, and it's a good proxy for demand for gasol and gasoline, right? If people want vacuum gasol to make in their cokers those products, and again, having this new contract VLSFO, how all the things are playing out in that blending pool. Then if you add naphtha to that and the beauty and everything that's going on, there's a lot of minutia playing around. That's basically your point, right? And it would be useful to learn more. But I guess you broached something that none of us can answer, but I hear you. It's something I think we should focus on going forward, because it's getting to that point that we mentioned normalisation. That's probably the theme of this podcast. That seems like that's not normal, and it was fine for it to be in pockets, but for it to be so sustainably out of whack, let's say, versus the story. And again, I think you have to bring it back to Brent Dubai. What is the state of play here? There's definitely opportunity. So I'll leave it there.
Yep.
Okay, so now let's move to where people have lost money, and that is the Widowmaker. So what's been the contracts of danger, let's say?
So we touched upon this a little earlier on this podcast when you mentioned the US-China news and how it's impacted more niche markets, even if it's not impacted flat price, like crude flat price. So we're going to look at propane, because propane was specifically really relevant when the US-China tariffs first came into existence last month. So just on my screen over here, this is the ARB between US propane and Asia propane, the LST Mont Belvieu propane versus FEI propane. So LST FEI prices rallied right after the Liberation Day tariffs on 2nd April. And similarly, the possibility of a resolution between the US and China now has been rising support for FEI propane, and therefore dampening that LST FEI differential, as you can see. So currently it's around negative 145. It touched negative 150 yesterday. And prices up. So even despite that small, that little bit of support just from day on day, momentum, as you can see on that second panel, has been increasingly going negative. So there is definitely more possibility of downside price action from here.
Yeah, this is an interesting one, because the arbitrage, I guess if you zoomed out, you would see that the ARBs have struggled to pull back much below, I guess, 150, 160. And this is a big seasonal trade, right? The propane market relies a lot on this arbitrage, and basically what you would have expected at the end of winter and coming into the kind of summer trading months. So, being in like April, let's say you're starting to trade Q3, you get like big weakening in the ARB. You get obviously the LST spreads coming off because just see classic seasonality. But the FEI benchmark, as in the Asia benchmark, has been all over the place because of the tariffs. Last year, it was a very uncertain market because of Chinese weakness, which the market hugely relies on China as a demand center. So that kind of put historical seasonal averages out of whack, the relationships out of whack. So it's interesting because I think the market's probably given up on to some extent on that seasonal trade and being massively short ARBs in the summer, let's say, and even at the end of last year we were still at minus 200 or whatever. So for it to be up here, it kind of made sense that people are going, do you know what, like FEI and the situation going on, it's probably quite, they need to be long ARBs anyway. They need to be locking in long ARBs anyway to lock in the hedges for shipping propane west to east, right? So it kind of does make sense that people would have hedged proactively and then kind of been ironed out on the FEI strength off the back of China coming back into the game and importing US propane. So suddenly that differential should weaken, and it does start to weaken. Now everyone's long, and they need to kind of rush to either unwind their hedges or unwind their spec length. So I think that does make sense. I wouldn't quite call it a widow maker because it's probably just a lot
of mark to market losses,
which they're probably fine with because they're just able now to lock in the physical flow at a cheaper level. But I see the point. There would have definitely been losses in the market on that. And it was interesting for me that so this FEI versus CP. So CP is the Saudi propane, FEI is the Asia propane, but the contract is about delivered oil from the US. So it weakened considerably with the tariffs, and then you had FEI versus CP. So that massively weakened, like massively below historical norms. And that was great for companies that sat outside the tariffs, like Korea and so on, who could they buy on the FEI benchmark, the imports, and they sell on the basis of CP. So they're like, that's gone out of whack. Great. I'm importing it way cheaper and I'm still selling it at the same price, kind of thing. And so they've done very well just to kind of lock that in. But outside of that, the FEI kind of weakness, I guess, has gotten in people's heads in the last couple of years. Like the relief rally we got from China, I don't think that many people made money from it, which is kind of surprising, to be honest. Like you would have expected news over the weekend, there was the rally, but was no one thinking about it, was no one positioning for it. And I guess that's an indication of, because the sentiment wasn't there, there's no real conviction and belief that FEI can perform because it's let so many people down in the last 2 years, if you like. And it's been such a roll-up trade long that hasn't worked. Why would you put it on now? Do you see what I mean?
And then often those, I had a look at the chart, and the sort of like gap higher in FEICP just kind of, it obviously didn't leave you much chance to sort of get involved and actually react. It was just like a, like
normalisation again.
This is normalisation, and it was probably when it was the Q4 FEICP was around like minus 25 or something at one point. I can't remember how low it got, but. You probably had hedgers buying that who are happy now, but I mean, just to buy that speculatively, thinking that like China and US might de-escalate tariffs, it's like that's still a bit of a gamble, isn't it?
Fair enough.
It's a very like esoteric way of expressing a view that China and US tariffs might.
It's true, but I did always think that the China-US trade war would. In particular impact propane because of how reliant the US are on exporting their propane to China. So that was always going to be volatile, but I think you're right. But then it's not clear like what's going to happen off the back of it. We need But certainly opportunity being made. This is the funny thing about saying Widowmaker and Gold Rush. It's like any market, there's winners and losers, right? So I think generally speaking, I can see the Gold Rush mentality of all the trade houses bound together and buy and they make money, cool. But then a lot of people looks like did lose money on the cracks. So you could call that a Widowmaker because Widowmaker is more like the unexpected, right? And caught unawares. And I think it looks like that rally in low sulfur fuel oil was probably people just not expecting a rally at all. Like what was the indication for such a tight market other than, I guess, fuel? So you probably could say that was a Widowmaker as well. So those are two very minutiae contracts. I think we should probably say, for the sake of people trading more vanilla contracts, people made and lost on let's just say the outright prices, Brent and gasoline. I say gasoline weakening has probably hurt a few people. Those de-risk moves has probably not been the nicest trade to be involved in. De-risking arbor versus heat that we've been going on about. That selling pressure, the selling pressure maybe from refiners, and generally seeming to normalize margins.
Would you say that there was like some speculative length in Brent spreads that have been a gold rush for the week? Because some of those kind of...
Well, the hedge funds generally have been short those. So I think, that it would probably come to the end of them losing money, if you like. And I think this time the rally has been a slightly more, as you say, probably more, not predicted, but I don't think people have been caught. So it's probably more people have made money than lost.
I was thinking maybe like, derivative guys at physical shops and sort of like proprietary, like oil specific shops. Would they have been buying Brent spreads against the refinery margins? It's kind of speculative play against the strong refinery margins.
Yeah, it's possible. Yeah, I get what you're saying, but it's always, I guess, we should always talk in terms of, it's probably a gold rush if the other side, if the one that's lost is hedging flow and kind of passive flow. So I think the thing with Brent spreads is like there is those fund rolls that they don't care, right? They're selling the contract they've got and buying the next month, but that's real time spread risk that someone takes on. So if it goes up, then generally speaking, people have probably done quite well, unless they were short before and using it to take profit. But I would say you're right. People have probably taken on these fund rolls at the beginning of the month or into the month of May for July or time spreads. And they've probably done quite well with that sell side liquidity, taking it on and performed. So that's probably a very fair one to be bullish. But I would say gasoline was a longer market and has probably hurt people more. Just generically macro, I'd say not been great for people on the gasoline side. And now de-risking that, where are you left? Like long short Brent, long short RBOB. It's not great. And I guess in terms of conviction. So I guess it's a good time to do the deep dive because Mita, you're going to talk about gasoline there. So this is where we go more into the minutiae, and it's the deep dive.
So yes, just talking about Q3 gasoline. So that's peak summer gasoline. You'd expect people to be putting on their bullish bets on this contract, but open interest over the past week has been stagnating in all three tenors of the Q3 contracts, that is the July, August, and September EBOB cracks. So just on my screen over here, you can see this for the July contract. Open interest has been declining over the past week. And so it's interesting to see that this de-risking is coming ahead of like just this close to the summer. It sort of resonates with what we've been talking about. Overall gasoline as well, that people are being less risky, putting less risk on gasoline before.
Well, taking risk off, right?
Yeah, basically taking risk off essentially on gasoline. 7-day flow has also been incredibly short skewed, as you can see over there. It's been around 10.90 long short for the July crack and for the August crack.
This is all the indication of profit taking, right? You've got very sell side flow in a long market. You got volatility coming off. You got open interest coming off. And all this selling is coming as traders have been in the money. So it makes complete sense that it's just people going, you know what, we're happy with this Q3 move and we're going to take profit. Pretty unexpected, I would say. I think it makes sense given where the margins are, but I'm still surprised. Are you not?
A little bit, but I was, after we talked about it last week, and what you said did sort of resonate with me quite a lot, that if you were long and you saw refinery margins where they were, and maybe you haven't got like an overwhelming bull story on gasoline,
it's a good time to take profit.
If you'd made,
maybe they're listening.
If you made $3 or $4 on the cracks, then you might not cut all your length off, but maybe it's like a prudent time to lock in some P&L.
That's fair. And I guess the other thing is flat price, as it rallies, you're also weakening the demand story as well, because $5-6 move on Brent is materially different for the end user. So you could get slightly less reason to expect more gasoline end user demand coming in. But I guess the reason why I'm surprised is I still would have expected the market to get into euphoria mode a little bit, right? So maybe it's indicating that people are actually doing quite well this year, because generally speaking, what you see is kind of what you said about low sulfur fuel. Where's the cheapest thing? Where can I put my money to? I've got to deploy cash this year. Where do I put it to make money? And if gasoline's rallying and it's on a good trend and it's not that high historically, I kind of would have expected a bit of euphoria and a bit of volatility spike before we sold off. But, fine, the market's
people aren't getting greedy.
Exactly right.
Yeah, yeah, yeah.
Exactly right. And maybe that's because it's generally been the standout trade this year. We've been talking about it for, I mean, we only been doing this podcast for maybe 6-7 weeks.
Yeah.
We've always been talking about Q3 EBOB crack being a buy, basically up until last week.
Yeah.
So it's just been a very orderly, predictable rally. And as we said, when do we get nice moves that people make money on? When the hedging flow is taken out and the hedging flow is passive and not bothered. And that was the refinery margin hedging that came in at the beginning of the year that was quite happy to sell these margins ahead of time. And they were well out the money, but I think maybe not too bothered about it. And that meant that the market could buy it. And it's been the weirdly standout low volatility trade. And with all this chaos, gasoline's just had like a kind of nice move after the tariff stuff. And just moved upwards, and then people taking profit, and it's quite rare to get a market like that, to be honest. And so if that's
true.
So if it stays still now, or has its that's fine, but we still have a couple months until those contracts start to price.
Yeah.
So if anything, it could be an indication of like some volatility ahead, or maybe at least if there is refinery outages that we think could happen, refinery fires, temperatures maybe heating up. We've had like the very warm start to spring here in the UK, and I hear in the US as well. So who knows? There could be, and if the market isn't very positioned there, then they could all rush in at once and cause a price rally in that scenario.
Especially if they've de-risked.
Yeah, exactly.
they've got sort of dry powder, because you've had it on RBOB as well. So yeah, it's not to say it's all over. It's just, if they
for now,
for now, if they're like keeping some kind of bullets free, then
I think it's pretty damn bearish crude in a way, long term, because if you're going to put a cap on that rally on gasoline, and I don't think any of us particularly believe in distillates. I've never really sat here in the last 6 weeks being like, there's a reason to be bullish distillates. Then the fuel oil and this low sulfur fuel, we don't have a story for that either, really.
No.
This is all indicating that the macro oil market, like the real solid, like looking at the oil market demand, it's not really the state of it and what the prices are saying, I think might be out of whack. And I think that's a good indication. Gasoline not being able to perform despite, potentially a good bullish setup means that was the kind of thing you'd be, if you thought it was a proper bull market, you would expect that to rally.
Yep.
If that's not, and the things that are holding up the refinery margin are making this market bullish from a product perspective are fuel oil and low sulfur fuel, and we haven't got a great story for that, and these things are super out of whack.
Yeah.
And if it turns out the local, like the physical premiums around the areas of the benchmark are not that high, I'd be pretty worried that the margins, which we've kind of been calling for, should compress very quickly.
Yeah.
And if everything starts to compress very quickly, or at least if the refinery margin crack rolls, if you like the refinery margin in near months versus the forward curve is backwardated, right? So if that rolls off and you get, look at Q4 margins and they're a lot weaker, if that kind of rolls down, all of a sudden you've got a really weak refinery margin kind of environment, and we were calling for high sulfur fuel shorts in Q4 last week. If that all does materialize and gasoline doesn't perform, and suddenly low sulfur and high sulfur fuel compress very quickly, suddenly you're in a very weak refinery margin market all of a sudden, and you don't have a spot market that's performing that much in the local North Sea markets, and then you've got potentially more OPEC supply. That's pretty damn bearish, the whole oil market. So I would say if you wanted to be not constructively short, if you wanted to be kind of short on a low volatility basis, you are waiting for these dominoes to fall.
Yeah.
And so it does look like maybe they are starting to fall if gasoline isn't going to perform.
Yeah.
Yeah. So this is a good time to move to the crystal ball. So crystal ball, we always start with the Onyx beta, right? So our prediction up, down in Brent futures, up, down in the front time spread, M1, M2 Brent time spread, the distillate crack in Singapore, and the European gasoline crack. And we've already kind of touched on a few of those. So if we just follow on for what we were literally just saying, I think we have to, the indications are gasoline doesn't want to rally. It's more in de-risk mode. So do we maintain a bearish view there on gasoline cracks?
Yeah, I think we agreed last week, and feel like I don't think anything suggests that should change in the short term anyway.
Yeah. And technicals, Mita, can we get it up?
Yes, so it's on my screen over here. So it's interesting over there that the 10-day moving average has been a very significant point of support for the contract until today's price action has immediately fallen below it. So a close below this level would be bearish, and a second consecutive close below it would, in my opinion, start off potential bearish sentiment,
Yeah.
for at least for the near term.
Nice.
Also, in the second panel, just to bring the MACD back, we're still in a positive momentum environment, which is also highlighted by the third panel over there, which is a new addition for the podcast. That's the directional movement. So that just looks at just the average number of up moves in the market versus the down moves in the market, and just to like sort of capture trend strength. So we still have some level of strength in the positive trend, which is something to keep an eye out on. But I mean, just with the MACD basically at zero now, I don't think that's a good indication for a strong rally either. So I would expect to see some short-term correction.
Okay, cool. So that's maintain that bearish view on the gasoline. Distillates, can we whack up that one?
Yeah.
Again, always one for me that's harder to predict this year.
Moving on to the Asian gas oil cracks. So we've got that on the screen as well.
Right, okay. So we probably had a bit of support from a flow basis of all that gasoline versus distillate profit taking, right? So heating RBOB versus heating oil filters its way through to the general distillate market and the crap there. So that probably speaks for maybe some of the flatlining. But if that's had support on a flow basis and it's still relatively flat, I think you just have to kind of maintain a bearish view here. I mean, we're not at particularly high levels, but again, speaking from normalization, this can get a lot lower, right? And I guess on the backdrop of, like I said, like a couple months of tariffs, can't really speak to huge economic activity, which is what diesel usually is a proxy for.
Yeah.
I mean, I can't really get behind a bullish move, so I'd have to be bearish that as well. Is that?
Yeah, agree. I still feel like on balance, you know, I know you've had the profit taking, but I still feel like at the moment wouldn't want to be bullish. Wouldn't want to be bullish diesel over gasoline. I still feel like gasoline can help.
So if gasoline's going to weaken, then
if gasoline's going to weaken, then I think diesel's definitely going to weaken.
Well, those are the meat of the refinery margin. So again, what are we saying? That the fringes of the refinery margin are holding up the kind of oil complex, if you like. But naphtha is starting to weaken too. I mean, that crack had been pretty stubborn on the upside. And I think you've got an industry that expects that product crack, so the naphtha versus Brent, to weaken quite considerably. And it is starting to move down. So you've got this kind of bearish trend movement on basically all the cracks apart from fuel oil. And again, repeating that, if we can't find a good story for why fuel oil is so strong, if it's not, usually you say fuel will be tight because the refiners are down or because the heavy supply is tight. And both things aren't true. So if anything, you've got way more risk of more supply of heavy from OPEC, and you've got no reason for the refiners to be slowing down given how strong the margins are. So it's a dangerously high heavy product crack environment right now. So if we think that could go as well, or at least it's vulnerable, you have to be bearish crude, I think. Being short M1, M2 time spread in Brent right now, I think people would probably think that's not a good trade, but you're up at like 60-ish. We struggled to expire that strong last month. We had a really strong rally up to like $1.20 in the time spread before expiry, and then it just kind of not collapsed, but it weakened and it ended up expiring around kind of like 70-ish. And if that was last month when the spot market was really on fire, I know there's the summer rally and stuff like that. I think it's going to struggle personally. I think actually, I would go more on the bearish M1, M2 Brent time spread, and I would probably now be kind of bearish flat price as well. But I don't know if you guys.
Yeah, I think on the flat price, I'd be bearish like I was last week. But I think from this week, it's that you've had the news now. You've had the US-Russia stuff. Sorry, US-China tariff stuff. So I don't really think that there's in the short term anything that can. I think that is either priced in or is overdone. So I'm still bearish on the flat price. No, on the spreads.
Spreads probably a bit harder because of the localized nature of North Sea.
I'll take the other side and just as an exercise and just I just feel like with the margins, for the sake of it, I'll take the other side and be bullish.
And to be fair, like
spread.
Logically, you know, if you're bearish those things, you should be bearish the time spread, but that's not always true, right? There's, again, I think another thing we brought up a couple of times. Localized benchmark strength or weakness is really important to recognize. You can always have scenarios where the benchmark is really strong, but the outside market is weak. That can happen. It's just localized impacts. And for sure, the North Sea players, if they want this to go up, they can have a good crack at it. I think the North Sea is relatively balanced. I think as the officials guys were saying, it's quite rare for these 40s barrels to be set in the print in the last few couple years. So for those to be coming online more, and it's a grade that needs to move east to clear, generally speaking. If that's struggling and the physical diffs are going back into negative territory even at all, that's not a good sign long term. But that, the North Sea market can hold out for a couple of months, or it always has been able to. Even COVID, you had a scenario where everyone was selling everything, but the front time spread still expired positive. Right. It was too close to expiry. People had already committed the barrels to move where they wanted them to move. So what ended up happening was the fly just roofed and all the other time spreads collapsed, but that one held up because the North Sea players have such a huge disproportionate volume, right? They hold such, all the volume basically. So when they do, if they don't want to give it up, they can hold it up for a time, right? And I think that's probably the state we're in. Right. It will probably be one of the last things to go. Okay. So I kind of see your logic there for sure. But I'm going to maintain bearish across the board. Mita? Yes. Brent, you want to get out the technicals again?
Yeah, the technicals are on my screen there. So it's interesting that just that little triangle that I've made is called triangle in technical analysis. That essentially means that prices are following this range that's defined by that triangle. And once it breaks out of it, it's usually a good indication that prices are going to break out in either direction. Okay. So this initially looked like a bullish breakout, but I think it's pretty concerning that the 30-day moving average is proving such strong resistance. Like yesterday as well, you saw that long upside wick and then just like immediately saw resistance. So just at this level, I don't think there's a lot of conviction to go above this 30-day moving average. I think the only way I would change this view is if it went above the 30-day moving average, for the next two consecutive days. But even then, the $68 to $70 range, which I've highlighted with that white line over there, that still proves as another barrier that the price would have to go through. So overall, I see a lot more hurdles on the upside, just price-wise.
Yeah, that's good. I mean, it's a good thing for people to keep an eye on as well, given how close we are to those key technical indicators. So, yeah, that's interesting. And can you just finish with the time spread, just the M1, M2? So again, we are probably, how long are we? 2 weeks away from the next expiry. Yeah. And so, it's been a volatile ride for sure.
100%.
But this is the rolling month. So this is obviously including a last month's rally as well. So last month's, look how volatile it was, right? We got all the way, this was peak tariff down to 25, back up to peak kind of 120-ish, and then kind of collapsed again into expiry. So very a big battle there, I would say. We've rolled forward lower, and actually when you eyeball the chart, it has rallied, but because it's zoomed out, it's actually struggling, isn't it? I would say that doesn't, even from a graph perspective.
Just zooming into this as well, I think it's super range bound right now, and you see a lot more. For example, yesterday's candlestick was what we call a doji, when we have a really small body and just these really long shadows around it. Yeah. That's usually a sign of indecision. And I think it's interesting that it sort of stopped at the 200-day moving average, which is the long structural moving average that price would normally follow. So that I think would be a good resistance level to keep an eye out on. And it's interesting that it sort of closely matches the shorter term 50-day moving average. So I think that's I think we might just see prices consolidate around that area for a bit. And just looking at momentum a little closely, this is still very much, just to go back on, we see a lot more downside days than upside. This is obviously skewed a little bit by that post-expiry roll down in price action, but it still goes to show that the past 2 weeks, this price action hasn't done much to negate this negative momentum. It still very much sort of shows how risk off people have been in Brent spreads.
Yeah, good summary. Okay, well, there you go. So that's, I would say, flashing the warning signs in oil. Yeah. If it can survive them, maybe more news, more geopolitical risk, then of course, things can always change. But if anything, I would summarize this. We had a relief rally from OPEC, a relief rally from tariffs. And the sentiment has changed, but it feels like people have taken that as a gift, right? Like they were long. We've had these relief rallies, good time to take profit on gasoline, on crude, and people are probably either on the sidelines or probably held their shorts, and they're probably coming more into play. Talking myself into this quite a bit, but that's why it's useful to talk everything out bit by bit, because it starts to give you, I've got quite a clear picture now. I feel pretty bearish, but let's see. Obviously, we don't know.
And it's good to sort of visualize that, that there's quite a few markets that are in that sort of consolidation, limbo-y state. Yeah. Well, it's the same, right? Like volatility's died down a bit. They're kind of whatever move has been happening has sort of gone a bit sideways. Like we saw Singapore gas oil crack pretty sideways, EBOB as well, and Brent
It's just
spread.
this fuel oil market. Like it's something we really need to focus on. And I think, again, we've mentioned since the beginning of this podcast these fuel moves, and Mita brought up the June-July time spread again. It's the spreads that perform so much, which we've got to remember. Spreads are a great indication of physical strength or weakness, but they're also can be useful from a relative value perspective. And if a spread is so high, it does mean the next month cracks are low. So that can be a great entry point for people, right? People love the roll-up trade in bullish markets. You have cracks performing, the time spreads also improve, which means the cracks deferred are quite cheap. So they buy those and roll them up. But there's another way of looking at it, which is that's a localized strength, be it a benchmark, localized strength, or just temporary strength. And that can just price off, and the time spreads price off with it. And then all of a sudden you're left with a low crack. It changes the whole economics of
and then everyone looks at that in isolation because the other one's priced out. And everyone's like, oh, the crack's not high anymore,
That's
basically.
what we just did with the time spread, right? Like 42 on the time spread. I thought it was actually higher. That's quite a bit lower month on month, and then suddenly you're looking at it going, oh shit, this is not that far away from contango, and everything else is in contango in the back end. This is actually potentially quite bearish. Exactly right. So flashing the danger signs, could be some interesting things on the horizon. And given that we're close to summer, and summer, we know people are banking on, at least in a crude perspective, some strength and dated refinery margins. People are probably thinking there would be blowout, although gasoline price action suggests the opposite. So really interesting time. And I guess we'll leave it there. But is it maybe just the final thing, because it will lead to the next video. Any standout trade that we can think of?
I mean, it's been a bit tougher this week. I've been trying to think throughout this whole last hour and a half.
Under pressure, shit.
What's what would I want to do? But I mean, there's ways of expressing. It feels like there's some contrarian kind of trades to sort of fade a bit of momentum, but that is
It's dangerous.
It's dangerous. Either selling like an EBOB crack or I'd probably rather sell a distillate crack, to be honest, than an EBOB crack.
I was going to say it is relatively ballsy, but given like we've talked it through and there's some decent justification, I think selling diesel flat price.
Okay.
Diesel outright prices, if you got the element of diesel cracks, I don't think should be performing and could collapse, right, ultimately, with a lot more supply coming online. And if flat price is not looking very strong, it's looking toppy as well, you kind of get a bang for your buck with product weakening and crude
sell the
weakening.
thing you think is going to come off the most,
essentially, or naphtha crack. We didn't talk too much about naphtha, but it's finally kind of broken through after a bit of a stubborn period, and it hasn't been quite as strong as fuel, obviously, but it has also been too high, if you like, historically, without making much sense.
And gasoline's been kind of felt like it's been like the main supporter of that. So if you have gasoline starting to wobble, then it almost feels like naphtha would actually be the better sell. Maybe.
So maybe one of the two as a flat price, I think would be quite a good trade, and
it'd be a good one to track.
All right. So keeping up with the last few weeks, tomorrow we will be releasing the extended Flux news show, which will cover the latest trade idea with Harry and Tom from Onyx Markets, and how you can get involved with that trade and anything else you'd like to do. So stay tuned and look out for that one. Thanks, guys, and thanks, listeners out there. As always, please give us the feedback if there's anything you want to hear about, talk about, or just comment on. We had someone's comment on Ed's haircut, I think. So that's always well appreciated. Thanks again, guys, and see you soon.